think the mistake is if you kind of lower your underwriting standards to try to get to 3 to 4%
Right.
of homes today, that's not going to work. But as long as you keep those standards the same and recognize like, hey, it's going to be fewer homes, make it all the way through. But there are still some homes that make it through. You just have to look harder to find that smaller number of them that do.
Welcome to Investing for Generational Wealth. I'm John Clive from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with investors, we're renovating over 1,000 multifamily apartments and building over 500 single-family rental homes. And we're expanding into private debt, industrial commercial real estate, and oil and gas ventures. Before we begin, as always, a quick disclaimer. We're not financial advisors. All investments are subject to risk, including the loss of your investments. So perform your due diligence before making any financial decisions and consult your CPA, your attorney, and any other financial advisors before making any investments. I'm your host today, John Lai from Clive Capital, and welcome to today's episode of Alternative Asset Strategies, Tailoring Real Estate Funds to Investor Goals. Today's guest is SeanODowd. Sean is the managing partner at Scholastic Capital, a real estate fund specializing in acquiring single-family homes in elite school districts and renting them to families on long-term leases. The strategy caters to conservative investors seeking steady cash flows and long-term value. Sean has a background working at BCG or the Boston Consulting Group and earned honors from the Wharton School of Business. Thank you for being here today, Sean. We gave a little bit of background on your experiences, but could you talk a little bit more about how you got to where you are today?
For sure. I appreciate the opportunity to be here. And that's the high level story. I was originally born in the Midwest, moved to Ton growing up, which got me interested in real estate. I was also the son of a teacher, so started noticing across all of those moves, hey, no matter where we live, there's a really good school district in that area. And that's a driving focus of how people make housing decisions. Ended up going to school, then worked in consulting and started to get more exposure to how to actually perform more detailed due diligence and realized could basically combine those two into a real estate fund offering that was focused specifically around really good school districts.
Got it. Now, why school districts as a class?
Yeah. So what we found with school districts is almost reverse engineering tenant type. Like if you're looking for a high earning, stable tenant, in most cases, they tend to be a little bit later in life. They're later in their career. They've had time for their career to compound. And as a result of that, they are most typically, if you look at demographic data, parents to typically 2 kids who are in middle to high school. And at that stage of life, a key driver of decision making is the school district that your kids are going to be going to. So for us, by reverse engineering that tenant type of like, hey, this is who we want to be renting homes to for a variety of reasons. How can we build a product that actually matches what that individual is looking for, which is a great home in a really great school district?
Yeah, and where are most of your investments based today?
So we are exclusively Upper Midwest. We own homes and we look for homes in Minnesota, Wisconsin, Illinois, Indiana, and Michigan.
Oh, got it. Okay. Got it. And so how do you attract those families then? I would imagine it's mostly urban areas, but it sounds like it's Upper Midwest. And do you have to do any special type of marketing?
We typically don't. So for us on these homes, like we're pretty intentional about buying homes in a really highly desired area, a really high-end school district that has almost no rental inventory. We specifically look for areas that have owner occupancy rates greater than 90%. There's no land left in town. There's no multifamily in town. And it creates this natural byproduct of really high demand area with low rental supply. We put the home available to rent on Zillow. About 60% of SFR rentals are done via Zillow. We list our home on Zillow. It's typically the only home available in that zip code. And then as a result, like the demand is very significant, and we're the only game in town. It makes it pretty easy to rent these homes out to a really high quality family.
Got it. Okay. Could you talk a little bit about sourcing? Like, how do you, obviously it's, the supply is very low, but how do you source your homes to buy?
We do we do a variety of different things. The vast majority of which are on MLS homes. And to do that, basically what we've done is we've built custom software on top of the MLS that we've fed in quite a few different parameters. We've got 17 different things that we're looking for. And that allows us to basically dump everything in the MLS on a live feed, and then very quickly filter down to the actual number of homes that we're looking for. At any given point, it's about 1.4 to 1.8% of homes on the MLS are what we're looking for, and are at a purchase price where we think we can buy and get good yield out of them. So as long as we have our data feed set up correctly, we can kind of cut through the noise of hundreds of homes that aren't what we're looking for to find the 20 or so that are on the market that are what we're looking for and are worthy of a deeper diligence look.
How do you look at the market today? So if you looked at maybe the 2017, 18, right, that would have been a good time to buy. And then
Hmm.
maybe with the low interest rates, but now that the interest rates are, no, I wouldn't say high, but they're high-ish.
Hmm.
And
Hmm.
the Fed has signaled that they probably aren't going to lower interest rates all that much this year, rather. How do you look at the environment that we are in today?
It's a good question. I think the most important thing is to not relax underwriting standards and what you're looking for. So like for right now, like roughly 1.5% of homes fit what we're looking for, and we think we can still yield at a greater than a 6 unlevered yield on cost on. If you go back to 2017, 2018, maybe it was closer to 3 or 4% of homes fit and were profitable to buy. I think the mistake is if you kind of lower your underwriting standards to try to get to 3 to 4%
Right.
of homes today, that's not going to work. But as long as you keep those standards the same and recognize like, hey, it's going to be fewer homes, make it all the way through. But though there are still some homes that make it through, you just have to look harder to find that smaller number of them that do.
Got it. Okay. Other asset classes. Are you interested in other real estate, other asset classes, or maybe even other asset classes in general? Given like your experiences with single family residences.
It's a good question, because SFR is, I think, probably one of the hardest operational businesses to be doing real
Right.
estate. It's much easier to be doing other asset classes. The challenge for us is we're not in love with SFR, the asset class. We're in love with the zip codes that we're in and the ability to get the tenants that we can and charge the rental premiums that we can. So if there were other asset classes that would enable us to do so, like we'd be interested in it. The challenge is we haven't been able to find another way to do that. For example, like we like the fact that there's no multifamily in the towns that we buy in,
Right.
because it gives us more pricing power. We're the only rental available. We basically can set the market. If there's a 100-unit multifamily complex, they're setting the market in terms of what the
Right.
rental prices are. Um, so it's almost like a feature, not a bug, that we have to do SFR because it's the only asset class that we can access these specific towns and neighborhoods in.
Yeah, and I was going to ask specifically about multifamily in, in maybe the markets that you're in, but it sounds like you've already filtered that out as a criteria.
That's right. We're looking for areas that don't have multifamily. We're looking for areas that have historically. We're looking for areas that don't have multifamily. We're looking for areas that don't have any buildable land left, and we're looking for areas where they have historically blocked any zoning variances that would allow somebody to knock down like two houses and build a multifamily on a combined lot. We want to be in those very high owner occupancy areas where they don't have rentals, because then we have a higher ability to set the market from a price perspective.
Well, given that you have a couple of years on your business today, what has
Mhm.
surprised you getting into uh, and operating your business? What has surprised you the most?
I think what's most surprising is I the more into this we get, the more convinced I am that at its core, this is really a data business.
Hmm.
Um, and I don't necessarily, I don't mean that from like an acquisitions perspective. Like we've seen, it's really hard to try to play like a Zillow offers ARB game on the
Right, right.
acquisition price of a home. But on the from an actually operating real estate perspective, like at its core, I'm convinced it's a data business. Like the most valuable stuff that we have and do is the data that we track on our homes and the ability to operate those homes as a result. Like I've got make, model, serial number, year for every single piece of equipment in every house. We have a request to go out to 123 Main Street because the furnace is not working so much. Like we're calling the maintenance tech and say, hey, you're going to 123 Main Street. It's a Carrier 123 furnace. It was installed 2 years ago. It's had zero maintenance requests thus far. Make sure you're bringing the parts forward because we've got a 90% confidence interval of, hey, this is the issue that's wrong with it. Then they fix it in one trip. The tenant's happy. Tenant resigns their lease because the maintenance requests are taken care of easy. The maintenance vendors love us because we're making their jobs very easy. Like those kind of like things on the margins is I think where the margin comes from in this business. And to do that, the data foundation has to be really, really strong.
Do you think that the concept of a data business extends beyond SFR, right? And I mean, Zillow, Redfin tried to do something different,
Mhm.
like that, they do iBuying instead, but they tried to do
Yep.
that not very successfully because they did try to do it in volume and kind of without even inspecting the home in many
Mhm.
times. Where do you think that ability to look at data and utilize data as a leverage tool, where do you think that stops? And why do you think it didn't work for like the iBuyers?
I think it stops outside of operate your own operational data. I don't think you can use, I don't think you can expect data to be an advantage on the acquisition side because then you're trying to outsmart the market, which people have been
Right.
trying to do that for the stock market or the real estate market forever. It's never going to work. But if you're using data in an operational sense with your own internal data on terms of how you're operating your own assets, there I think the folks who are using data have a big competitive advantage over the folks who aren't using data, and their margins are going to be a little bit better. They're going to be a little bit faster at operating. They're going to be a little better at taking care of the tenants. And I think over time and over a large enough portfolio that compounds out.
Got it. I'd be curious, having worked for BCG, if you were able to apply any of your knowledge there in what you do today, in your business today.
It's been BCG's been very helpful because a lot of what we do we kind of learned from the BCG playbook. Um, the data and operations piece that we've just been talking about, like that came out of the BCG playbook for sure. And then uh, a large part of the thesis as well kind of come from the BCG playbook. Like I did a lot of private equity due diligence work while there of like, hey, company hires BCG to say, should we buy this other company, yes or no? And the way to solve that question in most cases was um, what's the supply demand advantage? Like, is there a competitive advantage? Is there a reason to believe that this company you're going to buy is going to do well? That's how I think about real estate as well. Like, is there a reason to believe our homes are going to be more desirable for tenants compared to other homes? Like, yes, because we've got access to the good school district. Like, are we going to be able to charge a higher premium rental price? Yes, like we're the only game and only rental available in this town, and people want
Right.
to get into it. So it is very BCG to use your question.
Yeah, that's great. That's great. I mean, so I did some strategy consulting as well, and I always
Oh,
wonder
amazing.
like if I could apply what I learned into like what I will eventually do. Certainly, we can
Hmm.
consult for our clients, but yes, yeah, that's interesting.
That's awesome.
Um,
That's awesome.
yeah. Um, what's the end game for your business?
Yeah, so we are building the portfolio to be able to sell it down the line to a larger player.
Yep.
And SFR that really means Blackstone, Invitation, Tricon, or Progress. And we're building the portfolio where we can be in a position where one of them might overpay for it down the line. We don't have to sell. We don't put on 10-year term debt or anything like that where we have to sell at a specific point, but we're going to be ready. So when the market is a little hot and somebody's willing to overpay, like we'll be ready to do so. And that's why we're buying specifically Upper Midwest. That's how we choose the 1.5% of homes that we buy. We're operating under their criteria. We're operating under it like we're buying homes that we know they're going to want down the line. So it's very easy for us to bring them a portfolio and say, hey, here it is. You want to buy it and take it off our hands.
Could you talk a little bit about financing and what your capital structure looks like? Is any of it debt? And then how do banks look at a venture like yours? And also, are you taking on any investors?
Good questions. So for on the debt side of things, we do use debt. We're at 59% LTV. We are very conservative on the debt side. We also don't use anything shorter than 30-year term debt. We don't do floating. We don't do short-term debt. We use consistent long-term debt. Right now, our weighted average interest rate on the portfolio is 6.15%. And we primarily work with Midwestern-based community banks and similar that have bought into the thesis of like, hey, we know these towns, we know they're super desirable, we know it's a stable place, and we're willing to kind of lend on the capital stack as more conservatively in the capital stack. For that ties into the investor point, which is we are a true fund model, so we do have a significant number of LPs for whom we're investing on their behalf, and we're trying very consistently. Like we think of it from like a risk reward scale perspective, with like 10 being highest risk and 10 being like highest reward. Like we want to generate a solid like 6 or 7 on the reward scale for our investors, and we want to be like a 3 or 4 on the risk. We want to be slightly below average risk, slightly above average returns. So that's why we're conservative on the debt, and we want to be mindful that we're not taking on too much risk for our investors.
Speaking of investors, who is your typical investor?
We've got a couple of different profiles that we see most commonly. Profile number one is active LPs or active family offices, RAs, institutions that are looking for like a balance in their portfolio. So like they might put in $1 million into a development deal, high risk, high reward, going to double their money or go to zero. And then they put in $1 million to us, and we're their like steady Eddie. We pay monthly distributions. So we're just like their steady monthly dividend distribution play. The other type of investor that we see is a higher net worth individual who typically lives in a school district like this and goes, yep, I totally understand this thesis. I would have done this myself. I would have bought a couple homes near me, but I'm a doctor, lawyer, tech executive, whatever it might be. I don't have the time to do it. So I'm going to give you the capital to invest the way that I would have done it anyways myself.
Got it. Okay. Do you ever see, I think I know the answer to this, but do you ever see competitors in the market? Given that it's low supply, I suspect that it's probably the competitors are low and few between, and it may just be, other families looking to buy a home. But what does the competitive environment look like?
Yes. So when we're purchasing homes, it's almost exclusively us against people looking to buy homes to live in themselves.
Yep.
And on the rental side, we do see some competitors. They tend to be folks who did do this thesis themselves over the past 10, 15, 20 years. For example, in one of our towns, there's one competitor, guy's a dentist. He's bought a home every 3 or 4 years over a 30-year period, and he's got like 10 or 15 of them. And between us and him, we own like 95% of the rental market in that town. That's typically the kind of competitor that we see.
Got it. Okay. Interesting. For those that are online, if you have questions for Sean, feel free to drop them into the Q&A. We'll answer them along the way. So that is really interesting. I would imagine like short-term rental would be a competitor to what you have as well, but of homes is probably not as common. Do you see that short-term rental as a competitive asset class for you?
Typically, no. And the reason why is we're almost exclusively signing 3-year leases or longer.
Yep.
So we do super long-term leases. The reason why is the vast majority of our tenants move in when their eldest child is 14 and about to start high school. So the families are like, we're moving in and we're not planning on leaving until the kids graduate. So let's sign a 3-year lease or a 4-year lease or even longer because they're going to stay until the kids graduate.
Yeah. It's interesting high school and not like the middle school or elementary. Do you see that people are I guess the high school is the critical time when families do decide to move into a home for the 4 years?
That's right. What we've typically heard it seen, heard it described by tenants as like they're really thinking about college.
Yeah.
And because we're in the Midwest, it's typically like I want my kids to go to Northwestern or U Chicago, Washington, and St. Louis, Michigan, those sorts of schools. So I'm gonna bring my family to the best school district so they can get a great education. And 30 kids from this high school last year ended up going to U Michigan. Like, and I want my kid to be one of those 34 years from now.
Got it. Okay. Do you are you looking at other territories? Like you could replicate this in similar type of, demographic profiles, right? Similar type of regions. Are you looking at
Mhm.
those other type of regions as well?
So we aren't. There, to your point, there's a lot of really good areas around the country. Like Palo Alto, California fits our thesis to a T.
Right. Yeah.
Like there's really
Apart from
good
the
school
price,
districts
probably.
apart from the price.
Right.
But there's really good school districts everywhere with low rental supply. It goes back to us planning to build this portfolio for sale down the line. So we did the old consulting, begin with the end in mind. We've had a lot of conversations with those larger institutions. We've got advisors who are part of our team from Blackstone and Tricon. And the consistent message we've gotten from them is, hey, if you're going to sell us this portfolio in 2035, Upper Midwest is where we're going to be most excited to buy it. So
Interesting.
with that feedback we've been getting, then like we're sticking in the Upper Midwest, so we've got the highest odds of being able to sell the portfolio down the line.
Got it. So we're getting some questions in. One, which is,
Mm,
what's your criteria for a good school district?
there's a bunch. There's a lot. So for us, we're looking for a school district that is the data has us showing it's really high end. Um, the best data set we have is a data set that shows what percent of the high school graduating class goes to an Ivy League. There's a specific threshold in there where if it's above this percentage threshold, there's a material increase in our ability to charge a premium rent for it. Number two is perception. Um, if you ask, like, if I were to ask you, like, the best high school district around you, like, you probably have an answer. We need the people who live in the areas that we're buying in to immediately say that school district. And then number three is we're looking for durability. We don't want a school district that is like recently getting better because it can go down pretty quickly too. We're looking for a school district that has been really high end for a really long time and is unlikely to change. Like Palo Alto, California has been a phenomenal school district for a long time and is very unlikely that's going to change over the next decade.
And do you look at public versus private? So there are some school districts that are private versus public. Does that factor into your analysis at all?
It does. We are exclusively looking for public schools. We're looking for, and not public schools, not charter schools. We're looking for schools where, like, if you have an address in that zip code, you can go to that school, no questions asked, because that's the home that the parents are going to value, because then they can get their kids into the school district they want to.
Yeah. This gets to the next question, which is in all the markets you're buying into, how do you filter for the school district boundaries and manage any changes in those boundaries?
That is a phenomenal question, because that is a problem for us. If we were to buy in an area and then suddenly it's district to a really good school, and then a year later it's district to a not good school, like the value of our real estate just went down. We are looking for school districts that have not done rezoning ever, or redistricting. The school district is the school district. It's set. They're not changing it. It's never been changed. Because we don't want to have that risk. The other thing that we like to do is, if the school district is like a big circle, like we prefer homes that are closer to the middle of the circle versus on
Mm.
the edges of the circle, because then it's geographically less likely to be moved out to a different area. Or similarly, like we prefer school homes that are closer to the school district. Plus, for one side, like we can charge it's easier to rent if it's walking distance to the high school. But number two, it's also less likely to be redistricted away if it's like a block away from one school district, from one school.
Got it. That makes sense. That makes a lot of sense. What does your team look like? How is it
Our
structured?
team, yeah, so from our team perspective, myself and I've got one business partner who's my co-GP. I'm the business side, he's the legal side. He's one of the top fund attorneys in the country. On the operational team, we have four on the team: an operations manager, an asset manager, a controller, and a senior accountant. And then we've got an advisory board of eight. The advisory board, they're kind of like our board of directors. They all have a piece of the business. Some of them are SFR specific experts, gentleman from Blackstone, gentleman from Tricon, gentleman who runs a fund in Louisville, for example. And then the rest of them are experts on the Midwest specifically. One of the top multifamily buyers in the Midwest, one of the top multifamily developers in the Midwest. So we were trying to basically cover ourselves for like SFR experts and Midwest experts.
Um, Thank you for that. I would encourage others that have questions to answer any questions that they might ask any questions they might have. What advice would you give? Maybe it's a best practices question. What advice would you give to people who want to do and replicate a similar type of business plan that you have? Maybe going to a different market or maybe, similar type of markets.
It's a good question. I think the biggest thing that the biggest mistake that people make is jumping in too early. And I think it's really possible to build up an information advantage in real estate in not that long period of time. For like this is the way I think about it. There's 42,000 zip codes in the country. That means for every single one of those zip codes, there's one person in the country who knows that zip code better than anybody else. Like there's 42,000 experts on a zip code. Like make yourself one of those 42,000 people that's an expert on one zip code. Like if you want to
Mm.
buy, like pick a zip code, spend an hour on Zillow every single day. Know every single home if you're doing residential. Know every single home in that market that's for sale. Track them. Know what they sell for. Start seeing new homes come on the market, start making educated guesses. This home just hit the market, they're asking 500 for it. I think they're going to sell it in 2 weeks, and I think they're going to sell it for about 490. Track yourself, see if you're right, see how close you are. Within 6 months, I think you can become like the expert on that zip code, because most people don't do that step, and agents tend to be more marketers than they tend to be actual experts on the market themselves. Like you can build up an advantage where you get to the point where you know every single home by heart that's sold in that town for the past year. You can make a pretty educated guess. This house just hit the market. These three homes, I know there's three homes on that street that have sold this past year. I'm pretty confident what this home is worth. Like then you're at an advantage position where you can start buying, and you've got an information advantage to arb off of.
Do you ever buy off market, meaning you go and either yellow postcards or just essentially preempt the MLS and try to get ahead of any home that is being sold? Knowing that a particular street, for example, might not have a family and they might be retiring
Mhm.
sometime soon. Do you ever try to preempt any of that?
Yep, we do. The best way that we do that is uh, because property taxes are typically the largest source of income for school districts. Really good school districts have really high property taxes. The second order implication there is families tend to move as soon as they no longer need the school district, because why pay those really high property taxes?
Right.
For that reason, most sellers are people who just have their kids just finish, just graduate high school. Because these are good school districts, most of these schools publish a list of all their graduating seniors and where they're going to college in April, May of each year. that's your target list. That's the list of everybody who's going to be selling the home in the next 6 months. It's a super easy lookup to say like Sally Johnson is going to Princeton next year, and Sally Johnson lives at 123 Main Street. Like 123 Main Street is going to be for sale in the next 6 months. Like
Yeah, that's
hit them
interesting.
now. But
Yeah, yeah.
yeah,
That's a great strategy. I always
thanks.
I always would go and just look at um, the age of the individual, the owner, right? And that's
Mm,
another signal that you might have, but that's not necessarily an absolute signal. It's not going to be a positive all, 100% of the time. So I like that the graduating seniors, that's definitely a signal that you should, go and approach the owner. Um, what other signals are there like that you've been able to gather from data?
that's the best one for us for our specific zip codes. Um, there's other ones that people do use sometimes. Um, but for us in our zip codes, that's the most common one by far.
Yeah. Do you and maybe this is a question about when you first got started.
Hmm.
If you're most of these are single family residences, if you're trying to get a loan for a single family residence, yeah, the first one, second one, third one might be somewhat easy. As you grow to more and more of these assets in your inventory, it gets a little bit more difficult. Possibly
Hmm.
not so much with a commercial, like a local commercial bank.
Hmm.
Because if you structure these as commercial assets versus a residential asset, you're not
Hmm.
limited by the 10 loans that you
Hmm.
can get. Did you ever face that, or were you thinking ahead and structuring, your assets as part of a portfolio?
It's a good question. We were trying to think ahead on this particular thing. Um, at the end of the day, like banks are your business partner. Like if you buy a home, let's say at a 20% down payment, like the bank is your business partner and they own 80% of your business, which is your house. Like you
Right.
own 20%, they own 80%. And most people tend to think of banks as very transactional, but in reality, like they're your business partner. So for us, we were pretty intentional about finding banks that we knew we could work with for a long time down the line. So commercial banks, and uh, put a lot of time into building those relationships. So we could kind of start and work with them. And we do a lot to try to maintain those relationships. Like we send our banks reports on how the homes are doing. Um, most borrowers don't do that, but like the bank is
Right.
your business partner. So if you take the time to actually like, hey, like I have a P&L for the past quarter, like I'm just going to send it to the bank, and like the bank could go like, oh great, like they're on the ball, they know what they're doing, they're taking, I can see they're doing well, like everything's good. It helps you get better loan terms down the line. It helps you get a little bit more creative financing. But you got to your point, you got to start with finding the commercial guys who can work with you for the next decade, versus like taking your first loan out with like JP Morgan Chase, and then your second, then your third, and now suddenly you need to go find a new banker, and they're like, you don't have a
Yeah.
relationship built up that you could have been building over the years.
Yeah. Got it. How did you first broker that initial conversation with a commercial bank? Knowing that like you didn't have any assets, how did you start that conversation?
It was I spent a bunch of time basically looking around, and I tried to find the biggest real estate operator I could find in the area, and then said like, hey, who do you work with? Because that would theoretically be like a pretty proven bank and lender that had done a lot of work. And then once had that name, um, it was an effort of like, hey, reaching out to them. Like we got lunch a couple times, got to know each other, like build the relationship and build the confidence of like, hey, I don't have anything yet, but I am planning to. And there's a reason why it's worth your time, Mr. Banker, to invest like time getting lunch with me, because I'm going to bring you a bunch of business. And you're going to own 80% of my business, or in our case, 41% of my business. So like,
Right.
I want you to have all the information and data you're going to need.
Yeah, thank you for that. How has your business changed over time? What efficiencies have you implemented over that time? Or what, based on your learnings, and maybe talk about some of those learnings, what has changed over that time?
We've gotten better and sharper on all of our decision making based off of the existing data that's come through. So for example, I always give this example. It's the data point that we were most wrong on between our forecast and actuality was pet ownership rates and what percent of our tenants were going to have pets. We thought it was going to be like 25 to 30%. It's like 90%.
Oh,
Um,
wow.
so the single most requested thing we had from prospective tenants on leases is an enclosed backyard because they want to be able to let the dog out in the middle of winter in the Midwest
Interesting.
and not have the dog run away and not have to walk them because it's minus 10 degrees outside.
Right.
Um, so for us now, like not at all on our radar, but like now we've tracked that data. We know it's the single most requested thing. When we start looking for homes, like a home that has an enclosed backyard fence, like gets a little boost in our underwriting. A home that doesn't have a backyard fence, like we assume we need a $3,500 expense up to, depending on how big the house is, but like a $3,500 expense to put a fence on the backyard because the
Right.
tenants are gonna ask for it. So like things like that, like we've got dozens of those where it's like, hey, we learned something in the data. We can now get sharper in our underwriting and make it just a little bit better. That we can now get smarter. The other thing too is like our financial forecasting for the controller, like because we have that make model serial number for all of our different houses. It allows us, and then we pay for a pretty expensive but really useful data set that basically gives us useful life forecasts for all of our everything in all of our houses. I can say, hey, for this house, the furnace, I've got 16 and a half years of useful life left. It's going to be $8,000 when we need to replace it. I need to make sure we're putting $43 a month into escrow every single month for this house because we're going to have to pay for that furnace in 16 and a half years. It allows us to get sharper on our escrow. So we're escrowing the right amount of money. Which means we're not over escrowing and not giving the investors the cash distributions they should get, but we're not also under escrowing, or we're going to get in trouble where we don't have enough money to pay for expenses as they come up. So things like that, where we can just get smarter and just tweak it a little bit on the margins, is really where we're kind of seeing the efficiencies come in. I mean, most SFR funds operate somewhere in the neighborhood of a 58 to 64% NOI margin. Like that's kind of their bread and butter. But if we can do like three small things to take us from like 58 to 59, like that's a win. If we can do another two that can then waterfall us up from 59 to 62, like those things to kind of tweak it up. Like last month we were at 68%. Like those
Oh,
sorts
wow.
of things, we're just trying to like tweak a little bit to just get a little bit more juice out of it.
So back to your pets comment, I wonder if
Mm-hmm.
there's a correlation between pets and uh, the universities that students get into.
Mm.
Because if that's the case, I'm going to adopting a pet. Um,
That would be interesting.
so
I like it.
yeah, yeah, yeah. Do you use AI at all with like generative AI being so hot? Like, do you use AI in your business?
We do. We use it in a variety of different ways. Most of it is in like workflow stuff, where this happens, then dump it into this that then uses AI to then like AI agents really to
Yeah.
get things done. We're also piloting some AI. It's a company called Foxy.ai that uses image recognition on photos to basically score the quality of homes. So it dumps all the listing photos from Zillow into it, and it's like, this home is a 7.4 in quality, and we think it's going to need this much from a renovation. We'll see how good it is. We haven't tried it
That's
yet. We're about
interesting.
to.
Yeah.
But yeah, I'm curious to see like how that's going to work.
Um, yeah, that is really interesting. Do you find that you do have to, uh, there are renovation that's required in the homes that you buy? I mean, I would imagine
We
there
we
are for some, but yeah.
there's some, but we try to do try to buy homes with as minimal renos as possible, because our tenant base is really school district driven. They tend to only move in the summer, so we need to basically buy and rent homes spring summer because that's when the market's looking for them. So if we were to buy a home and then do like a huge renovation that gets delayed and doesn't finish until like November, it's going to be harder for us to rent it. So we're looking for like paint, light switches, basic stuff that we can do in like 3-4 days. That's kind of our limit from a renovation perspective.
Got it. Okay. We are getting close to time. So if you have a question for Sean, please feel free to drop it in here. Sean, what's not necessarily a learning, because you imparted a lot of different learnings today, but maybe what thing didn't work out as you necessarily planned? And you talked about the pets, but I'm thinking like one, considerably, huge fail that you thought that, you budgeted something or you scheduled something or you thought something would be the case and it wasn't the case.
Yeah, for sure. It's the worst decision I've made. I actually made it twice at the exact same time. Was we bought 2 homes in a zip code that was a great school district, but it didn't seem that way. Long story short is like there's 2 zip codes right next to each other. One zip code sends 100% of their houses to the really, really good school district. The zip code next door sends like 97% of their kids to a not so good school district, and like 3% go to the really good one.
Okay.
And we were like, great, we can buy homes as part of that 3% that go to the really good school district. The property taxes are way lower, so they underwrote beautifully because we're like, hey, good rent, lower property taxes, this is a win. And we had a incredibly difficult time finding tenants who were basically understood that nuance of like, hey, no, it's not in that town, but it is going to this really good school district. It's not going to the less good one. And it was I made the mistake twice because we bought 2 homes within like 2 weeks of each other in that 3%. And I learned that one the hard way of like, hey, we need to make sure we're buying homes where it's very obviously like this home, this school district, because when people are looking for homes, like they think, oh, like that town, Palo Alto, they look for Palo Alto on Zillow. They don't look for like Palo Alto High School. Zillow only released that functionality like a month or 2 ago. We need to make sure like town school is a much closer link.
Got it. Okay. One question we always ask our guests is, how do you give back to your community?
That's a great question. There's a variety of different things that we do. One is I try to help out at the schools as much as I can. So like I speak to different school classes like quite a bit for different things kind of across the gamut. The other thing too is we tend to be one of the largest landowners in most of the towns that we're in, because again, there's no multifamilies and most people don't own homes. So like we own more homes than typically anyone else in the towns that we're in. And for that reason, like we kind of think there's a role and responsibility we need to play to be supporting the local fire departments, local police departments, local libraries, because we are the largest landowner. Like we should be doing things to help out the library, the fire department, the police department as a result.
That's great. Thanks for that. If anyone was interested to find out more information about what you do and just about you and your business, how can they reach you?
Yeah. So we're scholasticcapital.com. I'm Sean at scholasticcapital.com. And then I tend to share a lot on like Twitter, which is kind of ridiculous, but I tend to share just like unfiltered stream of thoughts of like what we're looking at and what we're thinking about on a day-to-day basis on Twitter. So I'm also pretty accessible and available there too.
Has that changed now that it's switched over from Twitter to X? Has that changed at all?
It changes wildly on a week-to-week basis with like algorithm changes.
Interesting.
Some weeks it's just like random stuff, and some weeks there's actually like really good conversation about different real estate related topics. It's historically been a pretty fun place to meet other real estate operators that are doing slightly different things and learn from each other on. So I overall it's been a net positive.
That's great. We need to get into Twitter. We are primarily LinkedIn, Facebook, but we're also a little bit old school. So Twitter's old school too. So we definitely have to get back into that. Well, thank you
I love
very
it.
much for taking the time to educate us on investing in single-family residences in highly sought-after school districts. Learned a ton. I'm in one of those in the Portland area, but I'd love to find out more information about it. Again, thank you, Sean, for taking the time out of your busy schedule to speak to our audience. Don't forget to like and subscribe to our podcast and to our webinar on whichever platform you're listening to. And that helps us make sure that we can continue bringing you the best educational content. Thanks, everyone. Until next time, keep learning to invest for generational wealth.